Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Elston Asset Management co-founder and portfolio manager Andrew McKie. Andrew will share with us his current take on markets and where he is finding the best opportunities on the ASX. Andrew, it's nice to see you again.
Always good to see you, Chris. Yeah, thank you for the invite.
Of course. Equity markets, near all-time highs. There's a few problems though. We've got slowing growth, persistent inflation, rising unemployment. What's your assessment of the backdrop and how is it impacting your decision making?
Yeah, well, if you look at the index, it's driven by financials last year. In fact, 65% of the contribution of the return from last year was from 3 banks. And actually, it's close to 70% of the contribution for the positive return last year was just from 5 businesses, 5 companies. So 3 banks, Goodman and Wesfarmers. So when you look at the index, you've got to remember most of the points gains have just come from a very narrow set of companies. So there's a lot outside of that sort of going on. You mentioned the softer sort of economy and you've got a stagflation type environment. So we're seeing outside of those a sort of buying up of certainty, paying up for certainty and a selling of uncertainty, which you would expect, people to be uncertain around the outlook and not prepared to pay up for that.
Andrew, let's focus on the ASX more specifically. So we've got super money flowing in every week in a pretty high volume, passive investing gaining in popularity. How do you see the opportunity for active investors at the moment?
There's no denying that structural flow. As we know, super is going to get to 10 trillion. They're using a lot of passive product as well. So you do get this push towards a larger end of the market. I still think that you've got plenty of opportunities as an active manager. 2 reasons for that. The first reason is that even those top 10 companies, the composition of performance changes dramatically year to year. So if you look at last year, the banks do well, resources do poorly. If you look further back, say CSL was a hero of the index at 14% of the index and then has de-weighted from there. So even within the larger companies, you can get quite a difference in relative performance year to year. The second reason for optimism from an active manager's perspective is outside of those top 10 companies. There's some fantastic businesses. Yeah. And it's quite a big active position in the portfolio when you get outside of that top 10. So I think there's a fundamental opportunity when you look a little bit broader from that sort of concentrated index passive equation.
Andrew, we'll get to the opportunities a little bit later on, but I just wanted to set the scene for any investors that aren't familiar with the Elston methodology.
Yep.
Can you just share that with us and explain the benefits for investors?
We'll get the Elston out of the way early, Chris, so that's good. Look, we're a dedicated large cap manager, so we're ASX 100 only, 75% is ASX 50, so we're big end of town managers. We are a style neutral manager, so we're not growth or value. The reason for that is we think that it gives investors a smoother ride over the longer term. We'd say, see the Olympics, 800 metre analogy, a growth manager might win the first lap, value manager might win the second lap, style neutral wins the race. We find that, that's consistent with our 10-year track record. We've delivered that sort of outperformance and with sort of less volatility potentially year to year. So that's our core approach. Probably the only major change from other managers is that we have a team-based system. We don't have sort of the hero portfolio manager. We think that creates too much key person risk for investors. We also think that those investors have got biases. We've all got our personal biases. And so from a team perspective, it tends to iron out some of those potential biases and potentially lower risk decision-making as a consequence of that.
Andrew, we've just come out of reporting season, so I wanted to briefly get your take on that. And then as we move a bit further out in time, what sectors are looking appealing at the moment?
Yeah, we saw some key themes coming out of reporting season. Firstly, that the consumer was more resilient. Secondly, we had cost inflation driven mostly by wages, which then drove the third theme, which is cost out and productivity, particularly investment in technology to drive technology-based productivity gains. If you look at the consumer, it's an interesting time for the RBA because interest rates are affecting people differently depending on their demographics. Mm-hmm. So if you look at the 25 to 45-year-old cohort, they're the RBA whack-a-mole. As soon as there's a bit of inflation, whack, they get hit on the head. Whereas if you look at the 55, 65 plus, they're awash with cash. Interest rates are benefiting them. They don't have a lot of mortgage. They don't have young kids. They've got a rental property that's yields are going up because of rent increases, you've got great dividends, you've got fixed income on the portfolio actually generating decent returns. So they are awash with cash. They're spending that and saving that. So very difficult for the RBA to navigate that situation, because higher interest rates are actually potentially stimulating consumption and incomes in that older cohort, which is leading to higher, more persistent inflation. So, it's interesting, and we saw that in the results as well. From a cost out perspective, clearly wages are an issue. We've still got a reasonably tight labour market. The RBA spoke about that. And I'll talk about in terms of a theme later on around technology investments and the opportunities for companies to invest in technology to drive productivity.
Andrew, just to follow up there, if I may, the cost out story, that's not a never-ending well that companies can keep going back to. It's finite.
Yep.
Where are we in that cycle, do you think, of the ability to keep cutting costs out of businesses?
Look, I think we're in probably a potentially different environment for the next few years, and that's driven by automation and AI. I think particularly we're looking at large companies, incumbent players, those that have a large white-collar employment base, doing low-value task type work. We only saw that this week with the CBA announcement that they're looking to potentially get rid of their call centre in Australia and replace that with an automated AI application, and they're building more applications for that. So we think that this is a longer duration. It's the second derivative of the NVIDIA trade. Someone's buying those chips, someone's investing in automation, and we think it's those companies, those white-collar, large employers, doing reasonably low value tasks that can be automated, that you'll see significant productivity gains from over the next 5 years.
Andrew, let's talk about the banks and miners. They dominate the ASX and the thinking and the conversation. So what's your view on them at the moment?
Well, if we look at the banks, it's pretty clear for us, we don't want to be overweight banks at the moment. For us, they're clearly overvalued. If we look at Commonwealth Bank, relative to itself and how it's traded over the long term, it's sitting at three standard deviations from its mean average. Now that is nerdy stuff for statistically unlikely to remain at that level, that premium. So we're very happy to be underweight the financials. If you look at the miners, if you look at obviously iron ore, predominantly for Rio, Fortescue, and lesser degree BHP, the old story is true. Commodity companies boom on demand and they bust on supply. So we really need supply to come out of the iron ore market. So the higher cost producers starting to withdraw supply. We're starting to get some indications of that before you see a bit of a base in the iron ore price. So probably think it's got a little bit further to play out in resources, but that's our general view on it at the moment.
That's an interesting take on both of those sectors, Andrew, and a fair one. Where are you spending your risk budget as you're putting portfolios together? Where are you taking some risk?
Probably two key areas for us at the moment, that's healthcare. We've been structurally underweight healthcare. I think for 12 years we are now overweight healthcare the first time.
Just on that, is that valuation or is that the tailwinds of an ageing demographic and the ability to spend on healthcare?
It's driven primarily through our style, which is relative valuation, style neutral. So previously overvalued, people were paying a lot for CSL, Cochlear and so on. Derated substantially during COVID. That created an opportunity for us. So we own pretty much all the big names in the 100 at the moment in healthcare. Yep. So for us, that structural growth combined with technology cost out, combined with the cyclical tailwinds that are coming out of COVID still. So we like healthcare at the moment, particularly if we go into recession or stagflation environment we're at the moment. And then secondly, we like the global winners. There's a lot of great Aussie businesses that are doing exceptionally well overseas. So if we look at US, Europe, they're cutting rates, inflation's coming down, they're at a different cycle, they've got reasonably good labour productivity unlike Australia, so you're gaining that benefit. You're also gaining low currency, so US dollar earnings. So that's some great Aussie winners in large companies, and that's where we want to be at the moment as well.
What's one of those companies that's really winning overseas that you like?
Oh, there's so many. You've got Aristocrat, you've got Amcor, you've got Brambles, you've got Macquarie, you've got Car Sales. These are fantastic businesses. In the past, Australian company would do well in Australia and then go over to the US and make an acquisition.
Yeah, right,
and you'd call the US the graveyard of Australian companies.
Yep.
There was tombstones everywhere. That's not so much the case anymore. Australians do well overseas. Australian companies are real Aussie winners. Macquarie's a great example of that.
Andrew, before we get to a stock idea, I just want to understand some of the risks that you're navigating. What's the big debate going on in the Elston war room at the moment?
Oh, it'd definitely be the transition issue. When does Reserve Bank pull the trigger on interest rates? And for us, there's two-folded decision making. One is you've got opportunities in the more cyclical, non-defensive sectors that have been sold down. I spoke about that earlier, about selling uncertainty. So there's actually opportunity there. Versus why is the Reserve Bank cutting rates? And they're cutting rates for a reason. So we might be in recession, we might be in a soft economy, and what does that look like? So how you construct the portfolio, they're quite opposed outcomes potentially.
Yep.
So you can go too early on cyclicals, and we find that we're in a long duration slowdown, a recessionary environment for quite some period of time. So that's the debate for us at the moment.
Just to follow up there, Andrew, I think it's really relevant and pertinent for investors at home weighing up that same balancing act, I guess you'd call it. Is that something that you're talking about every single day, or is it in a weekly meeting? Like, how often are you visiting this issue, which is unfolding literally as time is ticking by?
Yeah, the team is very close and we work together, but we formally meet every week. And that's a topic of discussion. That's more top-down, approach that we're looking at overall what's happening, macro picture, sector implications of that. And then we've obviously got to combine that with bottom-up and happening with the businesses. But on a weekly basis, we're talking about that all the time. And it is a state of flux at the moment. It's unusual circumstances at the moment.
Yeah, it's not clear at all.
No.
Let's talk about a stock idea or a couple of stocks that you like, maybe a high conviction pick or something that you've added recently.
Yeah, I've got two for you. So we've got Challenger and then Lottery Corporation.
Right.
Challenger is a newer position for us. We like the growth in annuities. We think that there's a structural growth story there. When you think of annuities, both term and life annuities, in the past when interest rates were quite low, annuities were very unattractive for retail, but also institutional. That's changed. We're out of that QE sort of era. We're back into normal interest rates, and the annuity terms and rates that you're receiving are actually reasonably attractive for investors. We combine that with a demographic play, so getting a lot of people moving to retirement income phase. They want income certainty. Government also wants income certainty for retirees as well, so you need to be able to deliver that. Challenger is a dominant player. It is the number one brand when it comes to annuities in Australia. And so we don't see those structural shiftings for the next few years. And so they've got a lot of growth, we think, over that time horizon, that 3 to 5 year time horizon that we have.
And the Lottery Corp?
Lottery Corporation, we've spoken about, I think, in the past as well. Yep. But love that business. The more I look at it, the more I love it. Dominant monopoly position, obviously, in lotteries and near monopoly in Keno. But if you look at lottery, higher jackpots, they've changed the way that they're doing that. So the $200 million jackpot, bringing in a lot of news. Everyone's got the app now, which also leads to digital. Digital's more efficient for them, method of sales. So margin improvement from digital sales. Once you go on the app, you tend to roll your numbers over. So users tend to stay once they're on that app. So we like the pricing power of a monopoly. We like the digitisation story and the operating leverage. Unbelievable returns on capital in that business. So high quality business for the long term.
Andrew, I don't want to ask you to crystal ball anything, but let's just think about what the next 12 months might look like. Biggest risk that you see that needs to be navigated, and then potential opportunity as well over the next 12 months.
I think the biggest risk is the RBA's putting the brakes on, but they go too hard and they stall the engine, and it doesn't get off the track, and we've got to restart the car and get things going.
Again.
So my inclination is the RBA probably needs to be going now in terms of rate cuts. They could bring back interest rates to more of a neutral territory, which is at 3 to 3.5%. They're not going to stimulate inflation if they did do that. We're seeing inflation coming down globally. We tend to import inflation in Australia as well through, obviously imports and tradables part of our inflation. So we think the outlook for inflation is moderating significantly, yet we're seeing quite significant deteriorations in the underlying performance of the economy. So we could risk a recession here. So I think that would be the first big one. No one wants that. In terms of opportunities, it would be the incumbent businesses investing in automation and AI. They've got the customers to leverage that at scale. They've got the financial firepower to invest the money fixed cost up front and then leverage that across the business. So we think that is a longer term thematic and a significant opportunity for those larger businesses.
Just another follow-up there, if I may. How important is data in that role? Because generally the bigger companies have the best data, and data is what is going to power, as I understand it, quite a lot of the opportunity in AI. So how important is that as a factor?
It's a great point you raised, Chris, and I think that this is what we'd call the rise of the incumbent business over the disruptive business, because the incumbent already owns the customer. They have the data. So they can use that data, say, to find more customers like the customers they want. They can extend their market power and market dominance over a disruptive business. A disruptive business has a lot of cost in trying to attract customers. So an incumbent business can service those customers better using automation and AI and therefore retain them. It's harder to win that customer off an incumbent business. So, data is going to be key, and how to use that effectively, safely, but effectively to drive productivity in businesses.
Andrew, it's always a pleasure. Thank you so much for sitting down with Livewire.
It's been great. Thanks, Chris. Good to see you.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.